Hello, and welcome to today's New Capital webinar for Q2 2024. I'm Catherine Barr, Director of Communications at New Capital. And now I will get us started by reading our regulatory disclosures. This New Capital presentation is being made available for educational purposes only and should not be used for any other purpose. The information presented does not constitute and should not be construed as an offering of advisory services or an offer to sell or solicitation to buy any securities, related financial instruments, financial services, or other services in any jurisdiction. Past investment performance is not an indication of future results. Wherever there is the potential for profit, there is also the possibility of loss. Certain information contained herein concerning economic trends and performance is based on or derived from information provided by independent third-party sources. New Capital believes that the sources from which such information have been obtained are reliable. However, we cannot guarantee the accuracy of such information and have not independently audited these sources. Okay, and now I will welcome Leonard to the call.
Okay, Catherine, thank you very much. Welcome, everybody. It's great to have you and hope your summer's going well. Really enjoying the lower temperatures. I'm in Houston, obviously. I'm at the office, and the lower temperatures are great. Although we had a bit of a weather event a couple weeks ago. I hope everybody has recovered from that. And if there's, as I indicated in my memo to clients, week or two ago, if there's anything we can do to help you, if you have damage from the hurricane and you need any help with insurance or any other financial issues, please let us know and we'll help you. We have a really full schedule today, and we've got today's meeting slated for an hour and a half. I'll go as long as I need to if there are questions, but we're going to try to move. Some of you know that our family took a trip to Tanzania and really had a phenomenal trip. I highly recommend it. Some of you clients have seen this. Here's a photo that I took. I don't know if you can see it here in the screen. I took that. There's a lion kill of an eland, and just an amazing trip. So I hope you. If you have travel planned, I hope it's as exciting and wonderful as ours was. We really have two topics today to go over. One, and JC's going to join me. We're going to talk a little bit about, well, quite a bit actually, about performance. And then we are announcing the expansion of our model portfolios, the largest expansion of our model portfolios in our history. This is something JC and I have been working on since really, I'd say, the end of last year in our releasing now. And we're going to talk about why we're doing it and considerations around it. And that's going to take the first hour. And I'll be talking about market issues along with that discussion of the new model portfolios. Okay. And then for the last 30 minutes, a gentleman named Oscar Barbadillo, I think I'm pronouncing it right, is joining us from Henley and Associates. I spoke to Henley and Associates a few years ago and have struck up conversations. Again, they are the world leader. They're based in London, and they've got offices in Toronto. Oscar's out of the Dallas office. They are the world leader in residency and citizenship by investment. You pay money and you can gain residency. You probably know about places like Portugal and Greece. Well, what Henley does is they are consultants who help people set up those arrangements. And I think everybody is well aware that we have a very dramatic and turmoil-laden political environment in the United States right now. And I'm fielding lots of questions from clients about, what to do. And so I'll talk about that a little bit, and then Oscar is going to join us to talk about what Henley does. And just so you know that they exist, and they work with financial advisors to help clients set up those sorts of arrangements. Okay. So again, the first hour, I'm going to get into that right now. Just a few reminders. Our 2024 annual conference is October the 24th, and we're going to start invitations going out early August. Attendance continues to go up. We'd like as many people to come as possible. The topics this year, I think one of the most interesting topics that we're preparing, and one I've been thinking about a lot, is naming your beneficiaries. How do you decide who to leave money to, how much, and other considerations around it? And I have learned and discovered this is a lot more complex question than I had ever bargained for, and I think a lot of clients also. And I have found that people don't always get the results that they may be looking for. And in the conference this year, we'll talk about why that is and how you can avoid that and leave estate plans and beneficiary designations that really very precisely enable you to help the world and those who you will leave at the time of your passing in the best position possible. Okay, and then finally, on reminders, we sent out a request to hear back from clients about tax preparation services. We've been thinking about, for a couple of years, adding a tax preparation service where we would have an in-house capability to do client tax returns. Individuals, trusts, estates, small business, probably not large businesses, but we really need to get a count of who would be interested in that. We've heard from about half of our clients. We'd like to hear from all of our clients. It's such a big step that I don't want to take it if we don't have the business there to support it, for obvious reasons. I got to pay somebody to be here, and if there's not enough business to support it, then New Capital loses money, and I don't want to lose money taking on a new business. So we would want to hear from as many people as possible. You should have an email if you'll search your email history. If you've already responded to the survey, thank you. It's not a long survey. It's, I don't know, 8 questions or so, 10 questions, and easy to answer for the most part. And if you have already responded, thank you very much. If you haven't responded, let me please ask you to search your email history. If you can't find it, just send Catherine a note and she will send you a link to the survey again. Thank you very much in advance for your assistance on that. This is our core portfolio models, performance versus benchmark year to date. And when we say year to date, it's no longer year to date. It's through Q2. Since this is a Q2 webinar, we're giving you this data as of June 30th. The data has already changed dramatically over the last month. We're almost to getting toward the end of July, and it's already changed in our favor. But we want to show you, because this information dovetails and supports the new models that we're implementing. You can see year to date, our core portfolios are green. These are, you can think of this as New Capital, the green. This is a global benchmark, and this is a US only benchmark. And you can see that in general, the red bars are above both the green and the blue bars, meaning the US only benchmark year to date through this second quarter has outpaced the other two. Everything's done well. You can see that. Returns are all 10% or so for 100% stock portfolios, and for bond portfolios are 3, 4, 5%. The only exception where there's actually been money lost has been in the global benchmark for bond-heavy portfolios. And you see that our bond portfolios have absolutely performed stellar. You can see the green way above the blue here, and the green way above the blue here, and the green, way above the blue, and here, and here, and here, and here. But as things turn into stock-heavy portfolios, New Capital's performance begins to lag both the global benchmark and the US benchmark. And the US benchmark here, except for here, right, generally has outperformed. Now, it's only 6 months. And as I told you, things have changed over the last month. But I don't like to lag. And so these new portfolios are designed to remedy that. And the way that this manifests, when you get your portfolio quarterly reports, this is just an example. We just took a snapshot of one report, one client's report, where this would be the differences. You can see there are differences in the global benchmark. We started giving a US only benchmark last year. Some of you may have looked at your reports. Some of you may not have. That's perfectly fine. I don't look at my reports very often at all. So there's no one way to do it. But what you'll see is some difference. And this difference we call tracking error. This is a tracking error example, right? This portfolio here has about a 1% tracking error for this year-to-date report, about 7.5 to 8.5 between the portfolio return and the global benchmark return, and an even larger, add another 2%, 3% is pretty sizable tracking error versus the US only benchmark. Okay, so that's tracking error. Sometimes the tracking error can be positive, there can be outperformance, and sometimes the tracking error can be negative, underperformance, sometimes it may be equal. And these things move around all the time. The reason that our core portfolios, I want to remind everybody that I established the core portfolios 15 years ago or so, was to attempt to outperform the market to some modest degree. And to remind you of why, this is the data from 1928 to 2023. U.S. large cap, think about that as the S&P 500, had returned 10.3% on average each year since 1928. And a dollar had grown to be $14,557 by the end of the period at 2023. So if you'd invested $1 in 1928, I wasn't around back then, and I doubt that any of you on the call were around back then, but maybe some of you were. That would put you in your 90s, right? Mid 90s. 19, you'd be 96. So if we have any 96-year-olds on the call, you would have been born around 19. If when you had been born in 1928, you put $1 into the U.S. large caps, 14,557. U.S. large cap value stocks, less expensive, lower price to book, lower price to earnings, lower price to sales, pick your metric, but less expensive, value-oriented stocks since 1928, 11%. So about 0.7% better than the 10.3, and a dollar grew to 22,716 at 2023. And small companies, 11.9%. A dollar grew to $48,959 between 1928 and 2023. And small cap value, less expensive, lower price to earnings, lower price to book companies in the aggregate, 13.2%, 3% better roughly than what we'll call large cap S&P 500 type stocks. And a dollar, look at that, grew to be $152,290 over this period. That's the data. This is the data that underlies the statistics and the hard data science that underlines New Capital's core portfolios, which is the portfolio that we have invested clients in now for 15 years, since the beginning of our models. And now you see why. Because those portfolios tilt. They're not solely composed of value stocks. They're not solely composed of small company stocks in any way. They just tilt more than the market in general does. They tilt toward value and they tilt toward small. There's growth in there and there's big companies in there for sure. But we put a little bit of special sauce into the portfolio so that it tilts towards small and value in an attempt to get you over the long term. And that's the key phrase, over the long term, bigger piece of this. However, there is no guarantee that it is going to happen. Every day we wake up and we expect that small companies will outperform large companies and value companies will outperform growth companies. That is the expectation. That's the expected return. But there's no guarantee of it. And in fact, that is not what has happened over the last 10 years. And you can see that the core portfolios, although it's very close, have actually lagged we'll call the market portfolio. Those portfolios where there is no tilt towards small or value. Tilted, not tilted. And you see that for all bond portfolios, right? No stocks at all, 10% stocks. But as stocks begin to get added, we start to get underperformance. And here the underperformance is, I don't know, let's call it 1% or something like that over 10-year period for an all stock portfolio. You may be somebody who doesn't like that and doesn't want that tracking error. And if you don't like it, perfectly fine. Our new model portfolios will give this. But there's no guarantee that in the next 10 years, the green won't outperform the red. And the statistics and the valuations are set up right now that there is a possibility because of valuations that over the next 10 years, 10 years from now, hopefully we're all gathering, I'm doing this thing, that this webinar, there's a distinct possibility that 10 years from now, the green will outperform the red. That's just the way it is. And nobody knows what's going to happen in advance. Same thing in the United States. You can see that in the United States for a US only core tilted portfolio tilted more toward small and more toward value than the market in general is tilted, you can see some underperformance of the tilted portfolio, right? To the point here where it's about 2% a year for an all stock portfolio. Okay, so the expectation that small companies, value companies would outperform large companies and growth companies has not borne out over the last 10-year period. And right now we are in the middle of a boom that is driving huge amounts of capital expenditures into artificial intelligence. And that over the last year to two has driven this and exacerbated this trend even more. You can see that capital expenditures in 2024, what is expected, that the AI hyperscalers are the huge technology companies building huge data centers. Those companies are Microsoft and Google and Amazon, and Apple's just getting started going, but those are the huge companies that began as whatever they began as. Microsoft is a software operating system back in the late 70s for personal computers, is now a hyperscaler of data centers for artificial intelligence. Google, which began as a search engine at Stanford University in 2000, is now a hyperscaler of data centers. Amazon, which began as an online bookstore in 1995, roughly, is now a hyperscaler of AI data centers, and so on. And you can see almost $200 billion this year will be spent. And that is accruing to the benefit of one company over the last year and a half in particular, including in this year, NVIDIA, which makes the chips that go into those data centers. And you can see that electricity demand is being driven up by two things: cryptocurrencies and mining of cryptocurrency, but even more, you can see by the blue slice, by the growth between 2022 in terawatt hours of electricity demand for data centers. And all the data centers now are having their guts ripped out and new AI put in, and that's driving this boom, and that's driving growth stocks. And you can see returns here. This year, year to date, this is as of yesterday. This is from JP Morgan's data that I get every single, whenever I want it, available on a daily basis. This year, large cap growth companies, 21%, versus large cap value companies, 10.5%. Now, look, this is nothing to sneeze at. Blend companies, 17.6. A blend might be Walmart or Coca-Cola. You know, they're neither growth or value. You know, Procter & Gamble, think of them as sort of blue chip blend. But this is where the growth guys are. All of these figures, clearly the stock market having a very strong year to date through really yesterday. But clearly we're here in growth. But look, if you look at a longer time period, this is since the market low of the last bear market, March of 2020, which would have been during the pandemic. Take a look. Yeah, here's large cap growth. It's outperformed large cap blend, and it's outperformed large cap value. But look at this. Mid cap value has actually outperformed mid cap growth. And small cap value has actually outperformed small cap growth. So these things change over time. As I said, we wake up every day expecting that value and small will outperform, simply because that's what the data has shown us since the 1920s. We're coming upon 100 years of that data, and it makes sense that they would outperform because they're riskier. So our response is we are adding new model portfolios. As I said, we've been working on this for the last over half year. We have 3 categories of models now after our introduction today, and this is our formal introduction of the models. Our existing global core model, it has value and small factor tilts, and it is global. We are adding a new global market model, no factor tilts. You say, I don't want small and value tilts, fine. This is a global market model. It will have no factor tilts, has no factor tilts. For those of our clients who are interested in the ESG model, we have an existing ESG model, environmental, social, and governance, and we have quite a number of clients where that's important to them because those models represent a 99% carbon intensity reduction. And the last 2 days have been Earth's hottest in recorded history. Yesterday, Tuesday, was the warmest in history. The day before that, and it broke the record set the day before that on Monday. And we have clients who want to do what they can do. I'm not telling you this is going to save us from this problem, but we have clients, many of you on the call today, who want to hold a portfolio that's in accord with that value. This ESG category of our models, we have our existing global ESG, and we're adding a new US only ESG. So if you say, I only want US stocks, but I want ESG, we have that to offer you as well. And then finally, we are introducing additional US only. The US has outperformed over the last 10 years global non-US stocks. You may say, all I want is US only stocks. And we can talk about that. But if you do, perfectly fine. We have a new US core model, which has value in small factor tilts. and we have a US market model, no factor tilts. And I'm going to ask JC to join me now. What JC has been doing is JC has been putting together some pro forma modeling. Pro forma means this isn't actual results. We can't give you actual results because we've just been making these models over the last 6 months. And in many cases, a lot of the securities that we are using and employing didn't exist 10 years ago. The innovation in investment management, especially with the advent of ETFs, exchange traded funds, has been so extraordinary over the last 10 years that a lot of the instruments we're using for our new models didn't exist a decade ago. So what we've had to do is use proxies. We've had to use securities that approximate what we expect our new models to have behaved like over the last decade if they had existed and the securities in them had existed. And so JC has done extraordinary work over the last weeks to put these slides together for you so you can get a feel for how these portfolios have done in the past, would have done in the past if they had existed and the securities had existed. But again, everybody needs to understand, we have no idea what's going to come forward or be going forward. So we will talk to you about valuations after we show you these. Okay, JC, let's move into these slides.
Thank you. Okay, so what we wanted to show you here is put some numbers behind these new models. So what we're showing is our NCM Model 5 pro forma. So this is the 50% stock, 50% bond portfolio. And this is how all 6 variants of these new models have performed over these different time periods. So you can see in the 1 year here, the global core, kind of our standard model in the green. It's done a little over 10% over the 1 year period. And then next in the royal blue, the global ESG has done probably close to 11, what is that, almost 11% there. In the red, the global market. So these are the new variants that we've added. So the global market here in the red, I'd call that what, close to 12 and some change.
Well, 12 and a half would be here. So maybe 12 right there, something like that. Call it. Well, this would be 12 and a half. Right, halfway between, so call it 12.
12. All right, we'll go with 12.
I guess, yeah. All right.
All right, and then a U.S. core. So this is a U.S. Only with the core tilts, the value and the small cap that we've talked about. This is how that's performed over the year.
Maybe 12 and a third over the last year. Yeah.
And then the U.S. ESG. So now this one's creeping up closer to 13.
Yeah, about 12.6, something like that.
Yep, over the 1 year. And then lastly, the U.S. market has right there in the lead, just over 13% there over the 1 year period.
Yeah.
And then here on the 3 year, so on the 3 year, the global core and the green has actually done a little bit better than the global ESG over that 3 year period. And these are annualized returns. So now in the 3, 5, and 10 years, we're going to be talking about annualized returns. So I'd call that 2, maybe 3/4.
Yeah, this is 2.5% right here. So that'd be 2.5. That'd be about 3, something like that.
Yep. And then the global market closer to the 3 there. And then the U.S. core and U.S. ESG are almost right there, neck and neck in performance. And then U.S. market pushing the 5%. Again, U.S. market in the lead. And then going over to the 5 year, the first 3 there, very close.
Yeah.
I'd say, almost, gosh, 6.
5. So this is 7.5. So I don't know, maybe 6%, something like that.
6%. U.S. core pulls away there a little bit, and then the last 2, U.S. ESG, U.S. market, again pushing closer to probably 8 or so percent. All right, and the last here, the 10 year. So same trend here. Got the global core right around 5%. Global ESG just a hair more. The global market a hair more. So you can see here now they're all pulling in a little bit closer to each other. So the tracking's very small here, but then of course the U.S. market out there closer to probably 7% versus the 5% on the global core.
Yep. And so you can see things get a little closer over the 10-year period as, you know, more events happen, but a clear outperformance by the U.S. market versus more diversified variance over the 10-year period. Again, we don't know what happens over the next 10 years, but this is what the record is. And these are all basically, JC, these are all of our model portfolios is the way to think about it now, right? We've got 6 different variants of our model portfolios.
Yep.
And you guys can pick what you want and we can help you pick or et cetera. Okay.
Yep.
This is 100% stocks now, model 10. We don't have many clients in 100% stocks, but this gives you a clear view of what all stock portfolio would have done. Yeah.
Right. Right. So same picture here in an all stock portfolio. Of course, these returns are much higher than the page we were looking at before. So you see we're starting at the 1 year global core, closer to the 17, a little over 17%, slowly creeping up all the way to the US market, which is ending there about 23% maybe.
Over the last year.
Over the last year, yep.
Yeah, everybody, this is not what you get, not what you get every single year. This is over the last 1 year. Yeah. As of the end of the second quarter.
Right.
Yeah.
Right. And then over the 3-year period, so that includes 2022. So you can see the annualized returns dip a little bit here. Now this is an annual return over each of those each year over the 3-year period.
Right. Remember, everybody, we had a bear market in 2022. Stock market lost 20% in 2022. Bond market lost 13% or so in 2022. So, you know, that's in these numbers.
Right.
Big loser of a year in 2022. Yeah.
But still here, the global core has produced a little over 5% annually. Global ESG about 5% as well. Global market creeps up to closer to almost 6. US core, US ESG, again, they're a little closer to
so
8.
It calls 7.5.
7.5, yep.
And then this may be 9.5 on the US market.
Right.
Again, driven by, well, I'm going to show you what it's driven by in a few slides. Okay.
5-year here. So this is again annualized returns. That's over 10. I call it 10.5% there in the global core portfolio. Same with global ESG.
Not shabby. So it's not like we're talking shabby, but you know.
Yep. And then global market close to the 11% there. US core 13% or so, and then US ESG, US market again. Kind of taking the lead there, closer to the 14.5% returns each year.
And you know, JC, one thing we should note is that you tend to see US ESG and US market performing similarly because a lot of ESG funds will be light on energy, right, to drop carbon intensity, and heavier on tech stocks. Well, a big question is, as tech companies can start to rely on data centers that are burning huge amounts of electricity, are they so energy benign? And this is a big problem that a lot of the big tech companies are having to answer, which is how do they generate all this power for these AI data centers, and are they really as sustainable as they say they are? I know they'll make an attempt, you know, to buy solar and put solar into their data centers and so on, but it's a challenge. I think everybody's aware that all this cryptocurrency mining. I even read an article that there are towns in Texas, or a town in Texas, that has been tremendously adversely impacted by crypto data mining. Very little regulations, of course, here in Texas, and people who live in neighborhoods out, you know, I don't know, out somewhere in Texas, that their neighborhoods have been wrecked by the constant noise of generators and the din of these new data centers to generate cryptocurrency, and it's ruined their entire lives. There was an article recently I read about that. So we'll see whether ESG continues to be ESG, you know, but that's a reason why we see pretty closer performance between US ESG and US market.
Yep.
And then 10 years.
Yep. 10 years. global starting around 8% return per year over the 10-year period, 8.5%, 9%, and then pushing up through that 12.5%, almost probably 12.25% return on the US market.
Okay. Now we get to valuations. Now, there is no free lunch, everybody. If the preceding slides have caused you to say, oh, I want US market for everything, right? It's done the best, right? If I go back one slide, how do I go back?
It's a back arrow.
A back arrow? All right.
Keyboard, does that work? There you go.
Yeah. Oh, I'm looking at this slide here. You know, 10-year, 1 year, over the 1 year, the 3-year, 5-year, 10-year. All right, give me US market. That's what I want. Well, there's no free lunch in this business of investing. So now we get to valuations. Here's the cost you have to pay. So, all right, JC, here are the 6 NCM model portfolios.
Right.
Global core, global market, US core, US market, global ESG, US ESG, arranged by 3 different valuation measures: price to earnings ratio, the price of the stock, price of the company divided by its earnings, the price of the company divided by the book value of its of the company, the book value of the company, the equity book value, assets minus liabilities, and the price of the company, the valuation of the company divided by its sales. And all right, so take us through these 3 measures you've put together of the 6 new capital model portfolios.
Okay, so starting with the price to earnings over on the left, global core you can see is just over about 15 times earnings, which compared to the others is looking a lot cheaper especially compared to that US market there.
So it is the cheapest valuation wise of the portfolios on a price to earnings basis. And that makes sense, right? Because this US market has been so strong in comparison to other markets and factors over the last decade that the prices have risen to the point where it's a more expensive portfolio. Right? Is that how I said that right? And your data shows this.
Right.
So here we go through these. So a little bit above 15 times earnings on the global core, and then the global market is about 18.5. Is that right?
Yeah.
No, 17.5. About 17.5 on the global market portfolio, and then US core. So that's going to be about, so this is 17.5, maybe about 18. So the US core is about 18 times earnings. So that's a US only model of ours that tilts small, tilts value. And then the US market.
Yeah.
Pure US market portfolio, our new US market portfolio, most expensive of all the, on a PE basis, most expensive of all the models. And that's about what? This is 22.5 right here. So about 20, call it 22, something like that.
Yeah.
22 times earnings.
Yep.
Global ESG, less expensive. And then US ESG, getting close to US market.
All right.
And same thing on these other measures. Each time the yellow US market is the most expensive versus the others, and the least expensive is the global core. So we want everybody to think about that. When things get expensive, they are susceptible to returning to earth or more to earth.
Yeah.
Closer to anything else. I think we said it here. So,
yep.
All right. So stay on while we, so here's to substantiate what we were just talking about, valuations. This is the S&P 500, which is US large cap market. And you can see that right here, it is above, it is at the higher reaches of its valuation. This is as of July 22nd, which was 2 days ago, trading at, 21.2 times earnings. That's a forward PE. So that's on upcoming earnings, not trailing. That's on upcoming earnings, 21 times upcoming earnings versus the 30-year average, 16.7. Right, so it's 1.4 times overvalued according to a standard deviation. Here's one standard deviation, right? One standard deviation is 19.99 times earnings, 30-year average 16.72. So it's 1.4 on an overvalued basis. And you can see the market has been undervalued before. This is 2008. During the great financial crisis, as so often is the case, crisis brings undervaluation. Same thing here in the pandemic. Look at that big steep drop. Well, that was a great time to buy, and we did buy for clients. And then here's 2022. We bought here as well during the 2022 bear market that we were talking about. But right now we're in more of an overvalued situation, right? You can see that. This is the tech bubble. So we're not there. We're not here, 24 times earnings, but we're not here or here or here or here or anywhere here. All right. International stock valuations, before you decide, no, I want US only, and you may decide you want US only, but we are really enormously undervalued with international stocks, and it just continues to go down on an undervalue. We've now broken or touched 2 standard deviation undervaluation of a price to earnings discount for international stocks versus US stocks. The S&P 500 20-year average, 15.7 price to earnings, right? We just showed you that in the previous slide. Current 21.2, we were just showing you that. The All Company World Index, excluding the United States, so all stocks outside of the United States, think about it that way, 20-year average is 13 times earnings, and we are at 13.5. And so look at the discount, 13 times earnings to 21 times earnings of all stocks outside the US, right? And then on a dividend basis, you can see that dividends are international dividends, 3.3% is the 20-year average. We're around there, 3.1%, but look at the US, 2% 20-year average on dividends, 1.4%. These are slides I show regularly on webinars, but we are trying to weave these valuation slides into the model portfolios that we're showing you, the new ones. And then look at this. Industry sectors and market capitalization. Gray is large caps, green is mid caps, and blue is small caps for all these different industries. And look how the information technology, IT, is dominant. Large company valuations like the S&P 500 dominated by the information technology sector. Not so versus medium-sized companies and small companies. So when you buy small companies and you buy medium-sized companies, you're actually not just diversifying by size of company, but because of the enormous influence of several large technology companies, about 10 of them, you are actually diversifying by industry as well. You can see that here. I think that's a really interesting slide. Look at that. Large cap companies, 63% of it is growth. Versus mid cap companies, 63% are value. Small cap companies, also 57% are value. So mid caps and small caps are less expensive compared to large cap companies. And again, we see this here, top 10 concentration. Look, we're hitting an all-time high for this data dating back to 1996. Weight of the top 10 stocks in the S&P 500. 36.7% of the S&P 500 as of 2 days ago are 10 stocks. Out of 500 stocks, 10 of them account for over 1/3 of the entire valuation of the S&P 500. And you can see that that's continued to rise. So the big have gotten bigger.
Mhm.
Magnificent Seven, just another way to look at some of these stocks. You know, the Magnificent Seven, I can never name them, but Apple and Microsoft and Google and so on. And look at their returns. Look at the returns. Look at this steep return versus the S&P 500, excluding the S&P 500, which is blue. Take these 7 out that are the green. The returns of the Magnificent Seven are in green. Take them out and you've got the blue. Put them back in and you've got the blended, which is the S&P 500. But you see how critical and narrow the returns have been. And many professionals have been waiting for the stock rally to broaden out more so that it's not just these Magnificent Seven or top 10, however you want to look at it. And that is the expectation from an earnings growth standpoint. If you look at this boom that's come about because of this AI boom. Right? Look at this. Earnings growth of 50% for the Magnificent Seven versus -2 in the first quarter of this year for all S&P 500 companies, excluding the Magnificent Seven. But look, as we go forward, Q2, which we just finished, it starts to narrow. Here comes everyone but everyone else in the S&P 500, 6%, 28% starts to come in. And by the way, this is all in the stock prices. This is not a surprise to the stocks. It's in the stock prices. It's why the stock prices have done what they've done. The quarter that we are now in, that will end at the end of September, this is what's expected, 5% on the S&P 500 and 17%. So you see this boom period starting to come in, and actually what's being predicted for the fourth quarter of this year to begin on October the 1st is that there will be parity between this Magnificent Seven that have had this boom period and all the other companies. In other words, a broadening out of profitability. We'll see. Who knows? But this is what is being expected in the JP Morgan slides. And in fact, this is the news today from the Wall Street Journal. Tesla's profit falls for second straight quarter. Net profit tumbled in the second quarter. Tesla's one of the Magnificent Seven, and I think also maybe in the top 10. And I just want to show everybody. So net profit tumbled in the second quarter as the electric vehicle maker continued to feel the impact of slower demand and stiffer competition. That's what happens in business when you're making money hand over fist. Do you think everyone is going to sit around and watch you do that and not respond? Either other companies are going to enter your market, or the government's going to say you're a monopoly and we're going to do something about it. And this is the stock market today. All the red are growth companies today. And this is value companies. So look, value companies today are actually in the green. Growth companies today, given this news, and Google also missed its estimates. Google's struggling to figure out AI. This is very interesting. This is 1 week. You can see again, growth companies over here in this side, all in, phooey. All in the deep red for 1 week. Everything's in the red. Market's down over the last week, but it's down really more significantly in the growth sector. Here's 1 month. Look, what's strongest over the last month? Value. Versus we've got a little bit, and here is large cap growth right there. It's having some struggles. So you could say, well, why are you introducing these model portfolios at this time? And the answer is we don't want to stand in anyone's way. We're your financial advisors. JC and I nicknamed this project Project Whopper. Does anybody remember Burger King and their you have it your way? You know, you want the burger with pickles and no lettuce, fine. So we want to give people what they may want. This is 3 months. And you can see growth stocks have actually had a strong 3 months, but other sectors, value, have also done well. But this has been a period where so you see, as the time period changes, you get different results. Here's 1 year. This is a 1-year period. Large cap growth, 22% right there. Versus these, it's not shabby. We've already shown you returns are good across the board. But over in value, more like 12%, 22%. But take a look at this. Here's 3 years. Here's a 3-year period. Look at this, folks. All growth stocks are negative over the last 3 years. If you go back 3 years, value has actually strongly outperformed growth over the last 3-year period. You wouldn't know it, but if you include the negative year of 2022, when value stocks were more defensive, all these returns for value stocks, 6%, 5%, 5%, versus if you add in 2022, negative 2%, negative 3%. And so our point here is that don't think that, you can't get a fall in growth stocks and you can't get a divergence. This is why we diversify you and give you both. But if you don't want to tilt value in small, perfectly fine. Happy to give you market. And today is a notable day when the Teslas of the world and the Googles are. So let's move to wrap up here, because we do have Henley to get to. We now have multiple model strategies, and there are considerations. You have to decide, can you tolerate tracking error? If you don't want to see on your reports that there's tracking error of your portfolio versus a market benchmark, okay, then we would suggest the market portfolios for you. If you hope for some potential long-term outperformance of the market portfolios, again, going back to the 1920s, the best thing we can say is that the date is 100 years old, and we would expect small companies and value companies, if we tilt the portfolio with the regular core portfolios, even despite what's happened over the last decade, we would still say that that's the expectation. That's just the science of investing. They're less expensive and they're riskier. If you want to, and you don't have to choose either or, you might decide that you want to split your money. You may want half core and half market. You may say you want half global and half US. Fine. This is Project Whopper. We want you to have it your way. And so, but it will take separate accounts. We can't commingle the same strategy we can't commingle 2 separate strategies in one account at Fidelity. We have to have you set up a second account. The good thing about that is that Fidelity doesn't charge anything extra. We have, however, a $40 reporting fee that we have to pay through to Orion. And so there is that. So for $10 a quarter, you can have a second account if you want to have multiple strategies. You may say, I want to split my IRA and I want to put half US only and half global, or I want to put half of my IRA market and half of my IRA core. We'll help you do any of that, but it is going to take a separate account. Tax forms, you may get a few more tax forms, but that's not a big deal. We'd have to do additional beneficiary maintenance, right? If it's a separate account, we'd have to define your beneficiaries in 2 different accounts rather than 1. So we just have to make sure we do that. We're just trying to give you all the considerations. If you want to try multiple model strategies, we're happy to help you. And basically, we're ready to go on it. There may be a few tweaks we have. JC, we've implemented it for a couple of clients we've done a market model for rather than the core, but we're pretty much ready to trade it. And if you are interested, please email JC is the way to say, I'm interested. It doesn't commit you to anything. You may say, I just want to review this and see if this has any interest to me. The other thing is that there are tax considerations. Many of you in your non-IRA accounts, your regular individual or joint account, you got a huge gain in your core portfolio, in your core model. And so we may not be able to get you out of some of that money or a lot of that money, because you'll pay a big capital gain. And in no circumstance do I think it's worth it for someone to move from a core portfolio to a market model and pay a tax to do so. Absolutely not worth it. Okay. IRAs are a different thing where we can trade without any taxes. So your IRAs would be the first place we'd be looking if you wanted to try either the market model or the US only model. Okay. That does it. And Oscar is going to be next. Oscar Barbadillo. I'm going to introduce Oscar. Can we get Oscar to come on? Well, hang on. I got another slide here. So, and we'll take your questions at the end of today about everything JC and I just talked about. All right. And if you got to go, that's okay. You can email us questions and we'll get to you. Oscar's joining us here. Before I get and turn it over to Oscar, let me just give a little preface slide here. This slide is diversification responses to U.S. political turmoil. The key word being diversification. And this is as far as my mind is able to expand to conceive of the ways that one can diversify in response to U.S. political turmoil, whichever political persuasion you are. You know, if you're a Republican who thinks the world's going to come to an end if Democrats are elected, if you are a Democrat who thinks the world's going to come to an end if Republicans are elected, the answer is the same. That's the thing about this. Well, we've been talking all for the last hour about the diversified portfolios we give you. So we're already in the global models giving you diversified portfolios across the world. So that's one response. Diversified custody. We have the ability to put you in custody in Switzerland. Okay. I've talked about that a lot. So if you want your money to actually be in a vault outside the United States, because that's what we're talking about when we talk about custody, is where's the vault? Then we can put you in a vault in Switzerland. You can have a vault in Switzerland and a vault in the US. You can have a vault only in Switzerland and not in the US, or you can have a vault in the US and not in Switzerland, but those are where we have vaults. You can diversify your time by traveling, right? You can say, I'm going to travel for half the year. We just got back from Tanzania. And in December, my parents took us on a wonderful trip to Costa Rica. And I can tell you, when you're in another country, the noise of the U.S. political situation is just a lot more distant, everybody. And so you owe it to yourself. If the noise is too much, and I know it can be too much, take a trip and don't take one for 2 days. Don't take it for a weekend. Go take a good long trip. Okay. It'll do you good. And we can help you with that. How? By doing financial planning for you, because travel's not cheap and it's gotten a lot more expensive. And so JC and I can help you figure out, you want to spend some money on it? We'll tell you what your budget can afford. You can do it. So that's diversifying your time. You can diversify your political dollar investments. We can help you with that too. Okay? You are not powerless in this. Money talks. That's very clear. Money has had an extraordinarily strong influence on what has happened over the last weeks in the U.S. political scene, especially in the Democratic Party, where money came to bear on the president of the United States decision not to run again. I'm not saying that was the sole or the largest consideration, but boy, it was no question up there. And those people who pulled their donations, believe me, that was noticed. And so when you pull donations, it has an impact. And when you make donations, it has an impact. And I'm just sorry to say, if you're just sitting there and letting other people make donations and you're not participating, you know, you can't gripe too much about the results, right? You can give $10 a month and it's something. And now we come to Henley and his partners And Oscar, I'm going to introduce Oscar, who is going to talk about the last two bullet points: diversified residency and diversified citizenship. I'm going to take a few questions in the few minutes we have left that have come in that are focused on portfolio type questions. What is a tilted portfolio versus the core? They are the same. When we're talking about our core model, we're talking about the models that are tilted towards smaller companies and value companies. So those tilts, they're called factor tilts because the factors are the value factor, which has shown outperformance, has had outperformance, statistically significant outperformance. That's a key part of it, that it has statistical significance in the statistical studies of the data. It's not noise. It's a signal going back 100 years in the data that shows that there is a premium that is earned in value stocks. And it makes sense because if a company is lower growth, maybe even distressed, for that stock to be able to be bought and sold or be able to be purchased, it has to offer a potentially higher return or nobody would buy it. Same thing in small companies. Nobody would buy smaller company stocks rather than big companies if they weren't offering potentially a higher return. And so the two factors, the tilts, the factor tilts, are a value factor and a small factor. They're not the only factors. Others have been proposed with varying degrees of agreement by the academic financial community. By far, the two most commonly accepted ones are small company factor and value factor. There's a momentum factor, now there's a profitability factor. Those are debated more. But our core portfolios, those are tilted toward the value in the small company factors. Okay, next question is, given the recent outsized effects of artificial intelligence, of AI, can you comment? Is this a bubble? How might we compare to the previous bubbles, i.e. the tech bubble, the housing bubble? It's a great question. The companies that are the hyperscaler companies I was talking about that are building data centers, and those who are supplying them, the NVIDIAs of the world and the Broadcoms and the AMDs, those are the top three. Intel really should be in there more than they are. Intel's a really great example, again, of a company where if you went back 20 years and said, Intel isn't going to be the top supplier of chips for the next phase of computing, you'd be like, what? What? That's crazy. And yet time and again, we see that even the professionals, not just the professionals, but even the leading company in the production of microprocessors then isn't the leading player in graphical processing units, GPUs, right? Which are the underpinning of artificial intelligence data centers and the software OpenAI that runs on it. But there are a lot of profits being made in this area. NVIDIA's insanely profitable, making enormous amounts of money, and so is Microsoft and Google and Apple. So if we compare it to the tech bubble, where we had a lot of companies that had high valuations but didn't have a lot of earnings in comparison to the valuations, things are more stable now, for sure. I think that's the case. And the housing bubble, where we had people filling out housing applications who didn't have the income to back it, same story. The income didn't exist, the earnings didn't exist to back the mortgages that were being written. That is not the case here. there are big profits that are being made by the companies who are in AI. And the question is, have the stocks gotten ahead of themselves? And if things slow down, what does that mean for the stocks? So I don't see a bubble in the same way as the two bubbles, Mike, that you asked about, both the tech bubble and the housing bubble, where prices got beyond the fundamental earnings of both the companies or of the mortgage applicants. But that doesn't mean that there can't be problems in valuations, and we're getting some today, where Tesla, which also is playing in AI, trying to build its own data centers to support its network of automobiles, misses earnings badly, and Google is not keeping up. And so any slip in a company that's highly valued brings an immediate strongly negative reaction from the market because they're trading at high valuations. Hope that answers the question. I think it does. And then finally, the last question, what is a hypothetical situation in which a Swiss vault, i.e. a Swiss account, would be useful? Well, there's really two. If the country was to take a political turn where you felt so disgusted at the political direction of the country and you felt your rights were so being infringed upon in a way that was hopeless, you might just say, I do not want to keep my money in the United States. I don't want it to be held in a vault here. I don't trust the country across all sorts of reasons. And therefore, I am not comfortable or desirous. I don't want to keep my money in the United States if I can keep it somewhere else. That would be one reason. The second is if I actually, paradoxically, the country and the government said, you may not take your money out. That, I would think, is an extremely far-fetched situation, but countries where there's enormous political turmoil, governments will, and there is capital flight, and the government doesn't want assets to leave, might put some sort of control. And in that case, you might want to vault in another country ahead of time, because at the time that the government would declare it, you might be trapped and your capital might be trapped. So if you have a vault in another country, an account or accounts, and you have some concern ahead of time that that might happen as things slide, that would be another reason that you would be concerned that you simply couldn't get your money out if some sort of control was to be put into place. So those are the two reasons. That does it for another edition of our quarterly webinar. We will next see you all at our conference. We're not going to do a quarterly webinar in October because we do the conference, and I hope everybody who can make it will make it. It's been great to have you. If there are any follow-ups, and there may be, because this is a really long and extensive webinar talking about both new model portfolios. If you have questions about that, you want us to do any modeling or discussions with you about that, we're happy to do it. And about alternative residency or citizenship, happy to talk about that too. Hope you have a great rest of the summer, and thank you for your time today. Thank you to Catherine for putting all the technology together, as always, for the meeting, and to JC who worked incredibly hard to put all of our slides together for you to be able to show you the new model portfolios. JC, thank you so very much. I hope you have a great rest of your day and a great rest of the summer.